Welcome to Turtle Talk. Dive into the fascinating world of timeless trend-following strategies and the pursuit of the elusive outliers made legendary by the turtle traders. Join your hosts, Adam and Rich, alongside our esteemed co-host, Jerry Parker, as we uncover the powerful principles of classic trend following. From counterintuitive practices to the mechanics behind capturing market outliers, each episode offers a masterclass in navigating the financial markets. Expect in-depth discussions, expert insights, and actionable advice to help you master the art and science of diversified, systematic trend following, turtle style. Tune in every month as we explore the dynamic and ever-evolving world of trend following, equipping traders and enthusiasts with the tools to succeed. And now, without further ado, let's hand it over to your hosts, Adam, Rich, and Jerry.
Welcome back to the second part of our special. A couple of quick notes before we begin. We're a slightly smaller room today. Mike Melissinos and Ben Ford unfortunately can't join us today. So Jerry will carry the trend following side where Mike would have come in, and Moose is heading up the strategist side on his own. But never fear, we are in very good hands. So let me bring you up to speed as it's been a few weeks, or in case you're joining us fresh. In episode 1, we laid the groundwork. Here is the problem that both military strategists and trend followers face. You cannot see the future, your plan will not survive contact, yet you still have to act. Now, the military strategists worked on that exact problem for 2,000 years before the trend followers even arrived. And in this two-part series, we walk 8 of their ideas, asking for each one whether the answer holds on both sides of the room, from the military strategists to the trend followers. So we walked 4 ideas in our first episode last month. The first one being friction, the way every plan breaks the moment it meets the real world. The next being the fog, the fact that you can never see the whole picture, so you learn to respond rather than predict. And then we come to the loop, where the trained hand acts before it decides. And then to conclude episode 1, the tempo, where rhythm beats raw speed, and knowing when to do nothing is actually a real skill. So those 4 ideas were about the condition we all work under, soldier and trend follower alike. And underneath all of them sat one idea, the one we carry into today's discussion. In war, you have to predict because nothing tells you where the enemy will be. And in trend following, you never predict because the price already gives you the crowd's answer and you just follow it. So everything in this second episode builds on that. So if part 1 was about the condition, this part 2, is about the craft, what you actually do with it. So we start with the first idea of episode 2 called the Orthodox and the Unorthodox. How you win when you finally get your chance. So let's get into it. So here is an idea the old strategists kept coming back to. In any fight, there are 2 kinds of force. There is the ordinary force, the one that holds the line, does the expected thing, keeps the enemy busy. And then there is the extraordinary force, the surprising one, the unexpected move that actually wins the day. So you need both. The ordinary fixes the enemy in place, and the surprise breaks him. For us as trend followers, this maps almost perfectly onto how we make money. Most of our trades are small losses. That is the ordinary, the steady cost of showing up. And then every so often, one trade runs and pays for them all and more. And that is a surprise. So the whole game for trend following is surviving the ordinary so you are still there for the extraordinary. So let me put that in real terms by passing the mic to our in-house legend, Jerry. Tell them about a year of small annoying losses, the death by 1,000 cuts, and then the single trade that paid for the whole lot.
Oh, thanks, Rich. Yeah, there actually was a year where we had a single trade. 1993, I think, was a year of one particular trade. And that's going to be a function of how many markets I was trading at the time. Not that many, maybe 40 or 50 early in my career, right after the turtle story. And then we actually had a client who said, don't trade commodities. And the only thing that moved that year was coffee, and it was a freeze in Brazil, I think. And you just had to be there for that one trade, not handling that one trade. Sometimes you'll have multiple trends. You have a bigger portfolio. Multiple big trends will show up, or you just get lucky, like trading not a lot of markets, but one of the ones you're trading has a big trend. And this particular client said, why did I break even for the year and all the rest of your clients made money? And I was like, well, because you told us not to trade commodities. So that's particularly frustrating. Another way that you can be frustrated beyond taking a lot of small losses is for no good reason, eliminating the market. And if the client eliminates it, you kind of eliminate it, at least for that client. So coffee had a big move. You had to handle it well, and hopefully that the system handled it well. It doesn't always do that. It just brings up the idea how important it is not to trade more than 20 or 30 or 40 markets and try to put yourself in a situation where you're going to have multiple large trends that you don't have to be perfect on any one. So that's exactly what happened. Coffee was all about, it was 1993. It's the only thing that happened. And we're lucky to have that particular trend that particular year.
So, Moose, over to you, sort of in the military strategist camp. The idea of the ordinary force and the surprising force is everywhere. Take us into how the unexpected move is what really decides a fight and where that surprise actually lives.
So we could have a whole show just on this. And Boyd called it harnessing Sun Tzu, who Boyd said that Sun Tzu and the Art of War, which every trader should read, every human should read, every human that's engaged with reality should read The Art of War, because it's about being in conflict, not necessarily in combat. It's not limited to combat. It's for anything. Conflict, like trading, is conflict. Jerry just gave an example where someone created conflict, created a mismatch by saying, don't do something, and then that prevented them from doing something that they didn't have success in the way that they wanted. So we're always in a state of conflict, and Boyd was very adamant when it came to Sun Tzu, The Art of War, and he read about 8 or 9 different translations. That was the one book he could never find any fault with. And one of the things that's discussed that Boyd brought up in his most well-known briefing called Patterns of Conflict was the employment of Cheng and Qi maneuvers, and it goes to your term, the Orthodox and the Unorthodox. What I should do as a Marine, I had to correct your term earlier. You said soldier. I didn't know if there was any soldiers about. That's okay. No, Marines are still soldiers. We're just soldiers of the sea. But the Cheng and Qi would be the as a Marine, there are so many things that are conventional or in common for all of us that we train repetitively. We're all riflemen. We have very, very clear codes of conduct. We have 11 general orders for guarding property. We have a series of things that are, you could argue, templates or formulaic, or you've drilled for something in an immediate action drill so many times. And then when the environment unfolds and it doesn't meet what you would think or what was in the book, that's where you would employ Qi. That would be the unorthodox. So there's Cheng and Qi, the orthodox, the unorthodox, the conventional, and the unconventional. The surprise comes from, surprise is not an input. I can't say I'm going to employ surprise here, because I could say that. I'm going to surprise Rich when he comes around the door. I'm going to jump out and scare him, and he's going to drop his coffee and spill everywhere, and we're all going to laugh at him. But Rich he anticipated, you used the word predict. I like to use the word anticipated. Rich anticipated that. So when he turned the corner, he actually had a scream mask on, And then he scared the shit out of Jerry and Adam and myself, and we dropped our coffee, and it was at our expense. We were the ones surprised, right? So surprise is an output, not an input. I could want it, but I might not get it. Oftentimes, where surprise emerges is in those unconventional Qi situations where something happened that I can't compute. So if I'm orthodox, and all of a sudden I come around unconventional or unorthodox, or if I'm Cheng, and all of a sudden Qi, that Qi is designed to catch you off guard, to create that mismatch where you no longer have the ability to calculate what's actually happening, what's going on. So your entire process of your orientation is completely disconnected and shattered. I'm sure we could apply that same exact thing to when Jerry was dealing with the commodities trade or whatever, and the person, they recognized the mismatch and they were surprised. Well, maybe they relied too heavily on a conventional approach, and they limited themselves, and they prevented themselves from having that unconventional approach, or they were so heavy on Cheng they didn't think about Qi, so they weren't exposed to a certain asset class, and then they were surprised with the outcome. And it's there's got to be a balance to those types of things, and when we're orienting in reality, we should be open to those things, because we're constantly scanning our environment looking for mismatches, and that mismatch is where I want to deploy something where someone wasn't anticipating.
Look, I'm going to put a question to the room. So in war, the surprise works because there is a person on the other side who might not have seen it coming. That's if they've correctly posted that as a surprise, as you say. Because you're in that case, we're saying in war, you're fooling a mind. The repetition, etc., lulls them into almost a tempo or a rhythm, and then the Qi comes out and it destroys their rhythm. But in markets, there's no single person to surprise. So when the big winner finally pays, what is really happening? Did we outfox someone, or is it simpler than that? Just that the rare event is enormous and everyone else was huddled in the safe, ordinary trades and missed it. So first, from your side, Moose, any comments on that?
Well, it goes back to the anticipation, not prediction. I don't, because of uncertainty, because of the nature of markets and the nature of the world, everything's uncertain. I can only anticipate what could happen, and if I employ measures, if that contingency arises, then I'm not going to be surprised. If I tell Jerry no commodities, and I'm insistent upon that, and I'm like, well, why did our performance suck? And Jerry says to me, well, we didn't have any commodities, and you told me no commodities. I didn't anticipate correctly. I didn't allow for the possibility that the world is volatile, uncertain, complex, and ambiguous. So I didn't have any way to deal with it. And then when I ended up getting isolated into that situation. That's another thing. When Boyd talked about strategy, it's a constant game of interaction and isolation. And I would say that the trend follower that's successful is constantly interacting with the market, constantly anticipating what could be, or prepared for something that might not happen or might happen or whatever. Through interaction, I can have a better understanding of that, versus letting myself, by not doing that, allowing myself to be isolated. In the case of the person that didn't have exposure to commodities, that person is now isolated.
Look, I'm constantly being surprised by the market as a trader and as an individual, and quite often we get to the end of the year, or the fiscal reporting period, and where the profit came from is basically a totally unexpected source. Where you start at the beginning of the year and what you thought would play out sometimes turns out to be, most often than not, turns out to be something totally different. And as an example, I'm thinking about the oil market at the moment, and sort of thinking, if you told me a year or two ago that all these things were going to happen, and what would be your expectation for energy prices and the oil price, I would have said quite a lot higher than where we are today, as of today. But I guess that's what trends are all about. It's moving from one price to another price, and so moving from one equilibrium to another equilibrium, and that's what effectively makes a trend worth participating in for a trend follower that's looking to trade a long-term or a medium-term system, like we do. And so I guess for us, the discipline is about playing the odds of the market, and that all comes back to the back test. So, there'll be a back test, there'll be a lot of work in that. And then it's a question of just having the discipline to execute day by day, and maybe let go of some of that surprise and just go with the flow.
Jerry?
Well, the one thing that came to my mind was the most important thing for a systematic trader is to be very aware and wary when they're unable at the time to follow the process. And there's situations that can pop up with client requirements, like the coffee trade, or changes that you're making to the portfolio or the systems. And you're in a transition period or you're needing to trade smaller, and you're needing to exercise risk control and deviate a bit from the entries and exits and stop losses. I think you just need to be very conscious that there's nothing more important to sticking to the process. And when you're not sticking to it, for maybe even for good reasons or client reasons, this is a particularly vulnerable time where you should expect underperformance, and don't underestimate. Missing the coffee trade or the cocoa trade. These are critical issues, and in hindsight, it turns out to be huge mistakes. Even though at the time you can kind of downplay it, we didn't do the trade for maybe some good reasons, but these are some particularly vulnerable periods where you're in your mind, you're sort of telling yourself probably nothing's going to happen. That's when you really need to, any point in time where you're not following the system and the process, you need to be particularly aware that this is your most vulnerable time, because things can happen.
From my perspective, it's the market that surprises us. We know that the market offers these surprises, so we just know that we need to be in the market, participating with our small bets, expecting the losses continuously, but occasionally the market comes out and surprises us. So I tend to think we're the ones that hold the lonely position the other crowd walked away from, and we just wait with those positions. So, but
you make them pay.
Winner,
You make them pay for it. You make them pay for it. Like in combat, you're trying to deceive and fool the enemy, so they don't know what's going on and they can't anticipate what's going on. And in the market, it's what you just said, Rich. It's that taking that lonely position and then hold that long enough that everybody thinks you're nuts, and then it pays off, and then they pay for abandoning it.
Yeah. I think this brings us on to holding a big winner. This raises the hardest question of all. So when do you stop holding the big winner? When is a good thing run as far as it's going to run? That's the next segment we're going to go into, which is called the culminating point. So the idea comes from Clausewitz. So Moose, I know you've got to tell us more about him shortly. I don't necessarily think you totally agree with him, but you can tell us all about that. But in a nutshell, he was a Prussian general who fought through the Napoleonic Wars and then spent the rest of his life writing down what he had learned in a book called On War, that I believe people are still reading 200 years later. So he noticed that an advance has a culminating point, a point where your attack has pushed so far that it has outrun its own supply and strength. And the very next push, the one that feels like it should finish the job, is the one that breaks you instead of the enemy. The army that went too far gets thrown back. So I've got to be careful here when I'm talking about this in trend following terms, because there's an easy misreading here. So it's not about taking your money off the table as the trend matures. Trend followers don't do that. We let our winners run. But what it's really about is this: not dragging a giant position. a huge trend built for you on into the next trade. So it's about knowing when to get out of that trend when the trend ends, and not positioning your next trade to anticipate that trend still will resurrect itself. It's once the trend ends, you're back to that small starting bet. So, Jerry, I want to start with you. Walk us through the cocoa trade, because you lived this one.
Well, Coco had it all. I mean, I think it's just every lesson you want to learn from the markets, you can kind of learn from Coco. Don't take something off your portfolio that hasn't made money in a long time. You don't know. Put things in your portfolio just because they're diversifying. You can hardly stay there. The back test is the answer to every question, too. We did the back test. We have our rules. We're happy with it. This is what we're going to do going forward. We have multiple entries and exits, multiple systems with different look-back periods. It's all covered. Hopefully, we don't know how this particular trade is going to work out, but we do know over time that if we implemented these rules on every single trade in our future, this would give us our best chance of coming out on top and having performance that we'd be happy with. You can hardly stay too long in a trade. The back test in the computer says, let the profits run. You're a weak human. You can barely do what I'm telling you to do. I'm giving you the holy grail here of the back test, and you're having a hard time following it. Why is that? It's like no good traders should ever rely upon themselves to implement the trades. Your job should probably stop at the back test and the research and hand it off to someone else whose only job is to do the trades. Just take that out of the equation. But we want to get out of the trade when the computer tells us to get out, and when the back test, when our rules are hit and not before. We're already weak and trying to get out and book that profit because we're going to get an unbelievable itch scratched by just taking the smallest of all profits. It's just going to make us feel so much better. The other day, our buddy Mike was in dialogue on Twitter, and there was a stock that had gone up thousands of % this year. I forgot the name of it. It's one of the tech stocks, and it's sold off. SanDisk, I think. It had sold off. It had sold off dramatically, and some of Mike's followers on Twitter was like, Mike, I didn't know. Where did you get out? Where did you get out? Bemoaning how much profit they gave back, and Mike's response was, I didn't get out. I'm still in. And that was the only correct answer. The correct answer is not how much profit you gave back, and if you got out at a higher price. The correct answer is I followed my rules. I followed my system on this trade. It looks good. It doesn't look good. It's beside the point, because I'm laying the foundation for future trades, and I'm going to handle those trades correctly based upon my rules as well. And maybe those trades will turn out better or worse. But that's always the answer. We had a plan and we stuck to it.
Yeah. So Moose, take us to the military version, and also a bit about Clausewitz you can share. So talk about the culminating point in the doctrine.
I would tell, so most of the traders that I know and people that I've been in around the business with are voracious readers. And I would recommend, a lot of the things that I talk about and then you've seen in our podcast and Substack or whatever, I would tell everybody to get this book, Boyd, The Fighter Pilot Who Changed the Art of War by Robert Coram. One of the things he does a really good job in that book is talking about Boyd's battle with Clausewitz. And Clausewitz was a military reformer, part of the military reform movement post-Napoleon, where Germans like Clausewitz and von Moltke and others were trying to figure out, okay, we're never letting this happen again. We just got trampled by a guy from Corsica that came over and went all the way to Moscow. This is never going to happen again. And they came up with various reforms, and a lot of that was what Boyd carried and infused with his studies with Sun Tzu and Eastern philosophy and everything else. Science and math. And Clausewitz is like the John Maynard Keynes of warfighting. And if you read my most recent article about orientation as capital, the second installment of that, there's the free market view, the Austrian school, or the coordination economics view, and then there's the Keynesian view. Clausewitz is like the John Maynard Keynes. No matter how many things that you debunk about Clausewitz or show the gaps in Clausewitz, he's still going to prevail over guerrilla thinking or Sun Tzu or Boyd or other things. Just like Hayek is never going to get ahead of Keynes, or Mises is never going to get ahead of John Maynard Keynes, even though it's been proven and debunked and all that. And I could, as an economist with a master's in econ, I could do a whole nother. We could do a series of shows on that, but basically my description would be that Clausewitz is the John Maynard Keynes. There's some things that are valuable in what he says. He talks about things like friction and culminating point, but then there's absolutely other things where he completely misses the mark, and it's counter to something that's more human and complexity focused, like Sun Tzu would be. But culminating point is interesting because culminating point is that where success becomes a real danger, where we start bringing in things like complacency, and we're resting on our laurels, or we hit the apex and we're not going to do anything to reorient and try to get better. I think our last conversation, I gave a Formula One example of Ayrton Senna as being someone who's probably like the best person to shatter and reorient models, destroy, create. Another good one was Niki Lauda. And if you've read that book or you've seen the movie, Hunt versus Lauda, 1976, which I'm biased towards because I was born in 1976. That was like when you look at the contrast of those two thinkers, James Hunt hit the culminating point. He got his F1 championship by 1 point, but then he checked out. He got it. I did it. It's over. Whereas Lauda kept going. And trying to get better because when you hit that point, when you've exhausted your supplies, when you've exhausted all your energy and you achieve success, you have to reorient. You have to reorient in order to get to the next phase, because it's not enough. And Boyd showed this in his paper Destruction and Creation, that if you're not continuing to shatter and rebuild your models, even when you're successful, even when you won, you're going to at some point become obsolete or begin your journey to defeat, because you will have gotten complacent, you would have gotten comfortable, you would have hit your achievement, and then you've mentally checked out on improving your capacity for free and independent action, which is what he tells us that in reality we're obligated to do that if we expect to survive on our own terms. We have to keep doing that. That's something I think that Clausewitz really missed.
So, Jerry, how does this play out in the live portfolio? So, when a trend dies, does anything change in your sizing, and how do you stop yourself running the old big size that you previously had on your trend because it had these majestic profits on the next signal just out of habit?
Well, one of the things that I would say initially is that when I exit a trade, I'm following my rules, and that trade's over, and we have a clear conscience and a clear mind for the next trade, unemotional. But maybe the trend hasn't ended, of course, because it could go right back to new highs. And I got out even with my loose pants, I still got out too quickly. So, but when the trend ends for me, maybe my shortest term system, it gets out first, and the other three don't, and it keeps going higher. But regardless, I'm going to handle each one of these individually, and I'm going to. It's a new trade, so the same rules kick in with the new reality of maybe an increased volatility. So the short position in cocoa after the long position is going to be much smaller, usually after those big trends, because most of the big trends, the volatility increases a lot, especially a long trend. And then when you maybe get short the cocoa based upon your system, then it will be a smaller position. I think one of the things that Rich taught us was, don't have this mentality that when you screw up the trade on the long side, that you just need to make it back on the short side. So I'll trade it larger, or I'll change my system a bit. I kind of messed it up. I didn't make as much as I should have, but it'll probably fall a lot and go back down to where it was initially, and I'll make it all back. And these sort of things get into your head and into your brain and just override your feelings and your systematic process, and you kind of want to avoid that. Like I said in the last episode, one of the turtle rules was try to avoid trades if the last trade has been a winner. So you kind of want to have the opposite mentality that we're going to go through a period of choppiness. We're going to go through a period of false breakouts and getting that volatility a lot lower than it was at the peak of the uptrend before we're going to have a meaningful downtrend or a continuation of the uptrend. So you got to be careful with that sort of idea and not miss a trade. But that's probably a much better way of looking at it than thinking, well, we made it on the way up. Now we're going to make it on the way down. It just doesn't usually work that way.
Yeah.
Is that, Jerry, is that because people, when they do that, their confidence in their mind creates a template that they think, well, it worked once, it must work again? Is that the...
Not only that, but in that particular market. They need it to work in that particular market. And that's why, for good trend followers, they can really, like Rich said in a quote one time, you can cover up the name of the market, and I know exactly what to do. It does. The name of the market doesn't matter. We put the markets in our portfolio strictly based upon their ability to create diversification in the future, not because they had good trends or bad trends historically. It means nothing. And we're looking at these. We have no opinion of any of these markets and what they're going to do in the future, certainly not based upon anything in the past. Just as a group, we researched them as a group. Our analysis was of the group. We didn't segregate the longs and the shorts or the currencies and the commodities. They're all the same. There's nothing to be gained from a trend following perspective of over-analysis of the markets and the sectors.
Yeah, I mean, Jerry just gave a very great commercial for John Boyd's Destruction and Creation. He's affirming that those affirm each other. That you have to keep, even the things that made you successful, even the things that got you there, you still have to challenge those versus reality, because reality is always changing. And doing the opposite of that is exactly what he's describing of the people that are not successful. When you do the opposite of what Boyd's telling you, and you're not challenging your models, and you're not reorienting them, then you're resting on your laurels. You're saying you're basically selling templates. So this worked every time, so it's going to work for you, and it doesn't. That's not how reality works. Complexity does not work like that. So. Maybe that's what I should do, Rich. I should teach traders a course on Boyd's Destruction and Creation. There you go. Yeah.
All right, question to all, and I'll get Adam's thoughts. So, can the top ever be seen coming at all, or can it only ever be spotted after it's already turned? So, if we can only know in hindsight, then the whole skill of trend following is really about being wrong cheaply, about giving back only a slice of the move between the peak and the exit. So is the culminating point something you can actually foresee, or just something you can clean up after? Adam, to you, and then Jerry, and then Moose.
So I suspect not. And I think it all comes back to those unknown unknowns. So what is going to take us from this price to this price, right? It's going to take something that was not expected to move the market, radically in a way that's going to influence our P&L materially. And so I suspect you can't actually pick the top. And I think the equity markets give us a really good case study, because equities do have valuation metrics which we can apply. So I'm thinking of a metric like something like a Schiller PE, or a price earnings multiple, or a composite model that encompasses a few different valuation metrics like the Buffett indicator or something like that. And so you can have a market that, statistically is overvalued, price versus earnings, and yet is in a fine trend. Right? Here you've got effectively two conflicting positions. You've got a trend that you're way in the money on, and wow, if this corrects, it's going to be really, really painful. And at the same time, you've got a valuation metric that's saying this market is historically expensive. So what should you do? Should you change your trade in the equity market based on that other piece of information that might be statistically valid. And obviously the trend follower has to say no, right? They have to say, we're applying this trend following system based on the back test, and you have to ignore those other pieces of information, which in this case, they're not noise. A statistical model that is giving you a valuation is not necessarily noise. You'd have to consider it as a much stronger piece of information. But as a trend follower, if you're going to be pure to the trade, you've got to effectively ignore all of that and just focus on what does the back test, what does the algorithm tell me to do. And I love Jerry's idea of more than one model, because effectively then your trading system is not path dependent. So if you have 2, 3, 4 different algorithms that are giving you different entries and exits, you are not experiencing a path-dependent outcome in any individual market. They're going to be correlated, of course, because they're all going to make money in a strong trend. But that is going to allow you to fractionally exit a position and probably be more graceful in entries and exits.
Excellent. Jerry, anything to add?
Rich, I think some people can predict, and they do predict the highs, not the systematic trend follower, but some people do. Not only that, they predict the best sector to be in, the best stock to be in. And we listen to this and we're like, golly, maybe this is a way for me to improve. These sort of outside influences, they hit our brain, and here we sit in losing periods, not doing as well. With diversification, that's kind of been called a loser's game. If you don't know what you're doing, you diversify. So, and we see this success, and a lot of times people have this amazing success. They call the right sector, they call the high, the perfect trade, then they retire. We don't even see them lose it all back and make mistakes and be able to prove that it was guesswork and they were lucky. So it's really frustrating. We get tempted a lot how to make things better. I've actually had people I guess in the late 90s, we saw something that we had never seen before, and that was the dramatic dispersion between the NASDAQ stocks and the S&P stocks. And I remember where I was and what was happening, and this one group of stocks was just outperforming, and we just could not believe what we were seeing. And one of my colleagues at my firm said, you really just need to figure out which markets are going to be the best markets. I'm like, yeah, maybe you're right. So the success of others contaminates, and we have to defend it off and stay with our worldview that you can't predict the markets, the sectors, or the tops.
Yeah. Moose, do you want to finish off the culminating point before we move on?
Yeah, I mean, that's the hardest part. I think somebody said it, that it's usually clearer in the rearview mirror than actually knowing where it is. And this is another reason why I would tell trend followers, and I'm happy to help illuminate this for people that are interested. This is why it's important to know destruction and creation, because you would know that uncertainty is part of the state of the universe, and you can never know exactly where you are. And that's why Boyd used Heisenberg's uncertainty principle as one of his components for creating that. But we all tend to do that. Another person that I compound primarily, if you're familiar with my work with John Boyd, is Marshall McLuhan, and he's most famous for the quote, "The medium is the message." But what he's saying is essentially that the environment and technology have a direct effect on our human sense making and on our human sensibilities. And he said that we tend to look at the present in the rearview mirror. That so when we're marching forward, we're actually looking backwards. Kind of goes back to Jerry's point earlier. Well, that worked, so we're going to keep doing it or whatever, because we're constantly driving forward in the rearview mirror. Well, Boyd when you compound Boyd with that, that's saying that we're not reorienting. That means that we achieved success, we got to a level, but then we didn't immediately go right back to destroying and creating the models to get us to the next point, because, like Jerry said, the guy just hit it and then retired, and that was done, and then forever everybody thinks that person's always right. Kind of like my James Hunt example. He got the championship and he was over and he was done, and he was never going to do anything to keep going. and you have to do that because the environment, just like, the markets, they change faster than our perception. So looking forward and destroying and creating models, our mental models and our perceptions, is really the way to do that, not looking, in the rearview mirror backwards at what just happened, thinking that, well, I saw it once before, it's always going to happen that way. That lulls us into the complacency that the market or a competitor will exploit that gap and mismatch, and create problems for us.
All right, let's move on then to the topic of survival, because none of what we're talking about matters if a single bad trade can wipe you out. So how do you build so that no one blow can finish you? So the next segment we're going to be talking about is called Defense in Depth. So in war, you do not try to stop an attack at a single line. If you put everything up on one front wall and it breaks, you're finished. So instead, you build in depth, layer behind layer behind layer. You trade a little ground to absorb the blow, you slow the enemy down, you bleed his momentum, and no single break is fatal because there's always another layer behind it. So for us trend followers, that is risk management in one image. You spread your bets across many markets. You size each one small, and you make sure that no single trade going wrong can sink the whole book. But here's the twist I really want to land in this segment, and it's the part people miss. For us, the depth is not only defense. So let's make it concrete. Jerry, tell them about a market that nearly killed the people who were concentrated all in on one thing, while the people who are spread across many positions just walked away fine.
That's happened. I've read about this over time. Obviously, I think people like to get concentrated in stocks in different sectors and groups and countries and then call it diversification. I think that's the big problem. And the problem with that is that it works for long periods of time. And then you have a 50 to 80% drawdown because you thought you were diversified. And then nowadays they just throw in private equity, and that's even more diversification, although it's not. It's the same thing. I've heard stories over the years. There's been fantastic blow-ups when people have concentration, and then their confidence yields to more leverage. We're so confident in this, and the edge is small. So the only way for us to make money is to not only concentrate, but to use incredible leverage. I guess natural gas comes to mind. I think there's been a few blow-ups over the years. Another thing that encourages people to create these type of portfolios that are destined to blow up if they're wrong is that they're experts in a certain field. And thankfully, the trend follower is no expert. And he says, I need this diversification. How can we get diversification when I'm an expert in none of these markets? And that is because we're going to treat them with a systematic trend, a technical approach. And we can make a lot of money in soybeans, having never seen a soybean ever. So there's so many of these great things, risk controls built in, humility, and the mentality of a trend follower, along with the rules that keeps us out of trouble and dedicated to mass diversification. No matter what Buffett says or any of these fundamental people say, they have so much success with their best ideas, number 1 through 10, and it doesn't make any sense. Why should we overweight 10 when number 1 and 2 are our best ideas? We're leaving money on the table. And thankfully, the trend follower says number 1 through 10 they're all equal. They're all the same. There is no 1 through 10. They're all small bets with the same expectation. And that sort of idea keeps us alive and ready to fight another day.
Many thanks, Jerry. Okay, Moose, take us into defense in depth as the military means it.
Well, again, Jerry and John Boyd are on the same wavelength. Jerry said the trend follower is no expert. And John Boyd would love that quote. He might even write that down and put that in a briefing, because he loathed being called an expert. He thought that was a personal insult to be called an expert, because calling him an expert would imply that he knows it all. And his stance of destruction and creation is exactly the opposite. I don't know it all, because as reality unfolds, I have to keep learning, anticipating, destroying, creating my models. So he would align to that perfectly. He would also hated to be called an analyst because he says that an analyst is a half-wit. An analyst is really good at breaking things down, but if you don't combine that with synthesis, then you've failed. And an analyst has to be able to break down and then synthesize into something novel that didn't exist. So that's another thing that I think that trend followers end up synthesizing things versus just purely analyzing things. I don't know. In my career in asset management, I was surrounded by great analysts. They were phenomenal analysts, but they couldn't synthesize to save their lives. Back to defense in depth, I think that talks about what Boyd talked about. That was critical to success were 4 things: variety, rapidity, harmony, and initiative. And for what you're talking about here with defense in depth, variety and rapidity would be the focus. So variety is I have to have as you're talking about defense in depth, I have to have optionality of things that I can do for novel circumstances or things that I hadn't anticipated. I have to have a variety of things that I can do in different directions that will protect myself, but also to keep my enemy off guard. And I have to do that rapidly. I think that I talked about in the last episode around fast transients. It doesn't mean speed necessarily. It means oriented on a gap, identifying a mismatch that I can rapidly introduce a variety of puzzles and conundrums for my opponent, such that as I'm defending myself in depth, as you say, that opponent can no longer calculate or compute what's going on because they've lost all contact with reality. Those fast transients come in. I give them basically a menu of things that they can't figure out. It's going to shut down their whole entire plan. It's going to shut down their momentum. It's not merely giving ground, but it's also too in defense in depth. You want to be able to create a counterattack. It's not just defense that can ultimately be worn down till it completely depletes. You have to have some kind of a countermeasure to get out of that situation, either by starving off the enemy's attack or by meeting it with some kind of a counter blitz. Yeah. Kind of like I think a lot of the things that you're talking about too in trading is like you have to have the variety and rapidity because markets are always changing. They're always doing something different that you didn't necessarily predict or anticipate. So you have to be prepared for that to keep you alive.
So I'm going to throw it now to Jerry because we often talk about this with maximum diversification. This is where we talk about spreading the net wide. So, but in our terminology that Jerry and I use and Adam uses, it's not just about safety. It's not just about defense. So the same wide net that protects us is also how we catch the rare big winners in the first place. So, Jerry, I want you to talk to how our net is both our defense and our offense. And can you talk to that?
Yeah, exactly. I mean, nobody loves diversification more than the systematic trend follower, but we don't use it the way the rest of the world uses it. We want to include markets that are correlated, crude oil, WTI, and Brent, because one of those can have a big trend and one will just kind of sit there without having a big trend. They have different fundamentals and reasons to exist. There's multiple crude contracts around the world, and things can happen around the world in different places that will have different impacts on those crude contracts. We've seen it many times before where a certain highly correlated market will deviate. The first big turtle trade was February heating oil. It doubled in price, tripled in price, and the January contract didn't move. The March contract didn't move very much. It was only the February. So not only did that heating oil move a lot more than crude, it moved a lot more than the other months around it. So we're outlier hunters trying to find these outliers. And people have written papers recently and articles about this phenomenon. And basically what happens is the wider you cast your net, the less bad luck will play. we'll get roughly 5 to 10% of our portfolio will have a big trend annually. And having more markets in your portfolio makes it less likely that you'll come up with a zero. 20 markets, you could easily have no big trends. You just didn't have enough markets. Hundreds and hundreds of markets will lessen that negative possibility that you will be shut out or have a very low number of trends, and smooth out your annual returns, even though by definition, being an outlier hunter, we're not really all that interested in sharp world and having a smooth return. We're interested in capturing these trends and surviving this bumpiness in order to let those profits run.
Look, I just want to ask a question to all. There seems to be a slight difference between depth and defence from the militarist's perspective versus the depth that we're talking about. In trend-following world, we tend to use depth as both a defensive and offensive measure. So does the soldier ever get that? Does the militarist ever get that? Or is it just defensive?
Yeah, it's not really a Marine concept in the sense, we're more attackers. We sometimes the best defense is a really good offense, and defending and holding ground for its own sake is not really in our offense. There's times where you have to defend yourself or set up defense, but that's not really that's not really how we're designed. We're more designed as something of an offensive weapon to strike where the enemy is the weakest in a way that catches them off guard and surprises them. If I'm hearing you right, a trend follower is more of an attacker, and they wind up being an attacker that others want to emulate, or that surprises others because they're doing what others don't and they're getting benefits that others don't. That doesn't really sound like a pure defensive operation. There's things that we do to protect and defend, like for security, like we position size and other things, but I don't necessarily think that's defense in depth for its own sake.
I've often viewed ourselves as being predators that lurk in the abyss, in the abyssal depths.
Yeah, that's more the Marine. That's more the Marine or the Navy SEAL that strikes when you least expect it, that comes out of the dark and hits you so hard and you have no idea what happened. And then there's examples in the animal world when you see that gazelle going down for a drink of water and that croc comes up out of nowhere, grabs him and brings him back in. That's more the ethos, I think, that governs Marine operations versus things that are defending. In the U.S. Marines, our expeditionary nature is one to sustain itself for a fixed period because we don't have the ability to prolong and defend ourselves, say, like the Army or a larger conventional force would. So to hit and ride and shock would be more of the of the approach versus to kind of hold on what you got. The other thing too about ground and holding ground and defending, you got to be really mindful of what Boyd said, is that ground does not fight wars. Humans do, and they use their minds in the process. It's the same thing. Money and trading platforms don't fight wars. The trader does, and the trader uses they use their mind. A lot of the times defense is cognitive versus a dollar amount or a platform position or anything like that, I would think.
Well, you're giving a great segue into the last segment where we were talking about the strategist's mind. But before I leave defence in depth, Adam, anything to add here? Or
look, all I know is that trend followers just seem to be losing all the time. Because 50% of the trades are losers, and you're like, well, then how can you ever make money if you're losing all the time? And it's because we take really small losses on the losing trades, and then we let the profits run on the winning trades. And so everybody gravitates to the winners and wants to experience the winners. But like half the job is managing these losers. And so to get better at this or get good at this, you've got to become a really good loser. And the problem is no one likes losing, even if the end result is that you make money, because we're just like hardwired not to want to lose. And so you've got to let that go and just be graceful in your losing. And then as to whether it's attacking or defensive, I find that these systems can be both. When the model is exiting and reducing risk, I feel like it's really defensive and can deleverage really nicely. And then when trends rebuild, I find sometimes these algorithms can be really aggressive because they're looking to buy back something that maybe you only sold a couple of weeks ago. And you're like, wow, I'm already back into this market, even though we just got wiped out or had a huge reversal. So I think it's a fascinating topic. I'm not really sure which side of the fence I land on, but some graciousness in losing is definitely a skill that you need to develop if you want to trend follow.
Thanks, Adam. All right. Well,
if I could just comment on that, Rich. I think that's a really good thing that Adam said. We're just losing all the time. I've seen good traders and amazing traders kind of love the idea that their winning percentage is even way less than 40%. It could be in the 20s. It's almost like they embrace it so much that and want to just. And to them, their strategy is much better if they just try to get winners as low as possible. I've seen this happen to lots of traders, and it's just like, look, I'm trying to be comfortable with this 40%, and you're in the 20s, and it's just loving this pain. And I think that's a good sign of a good trader, is to really just do what's right. And if it brings more pain, then just bring it on. I'm going to get confidence from doing what's right. But one of the sort of cliches in trading that I really think has limitations. I'm trying not to be too negative about it because you may disagree with me on this, Rich. But one of the things I hear all the time, and that is don't care about the winners, just care about the losers. The winners will take care of themselves. And I think that no, the winners don't take care of themselves, especially with a strategy where you've got to do the right thing with the winners. It's critical that you maximize the system does well in the majority or overall in these winning trades. And if you mishandle the winner, it doesn't pay for the losses. And so you've handled the losers great. You had great diversification. You got longs and shorts. You're taking small losses, but you got to hit the winners to pay for all that plus the return. And if you only pay attention to those losses, then you may put yourself in danger because you didn't take care of the profit. You got out too quickly. You didn't let your profit run. So it's sort of combined, and it's kind of the and who doesn't have time to do what's right with the winners? Like, I'm so busy, I'm so distracted by other things that I'm not going to pay attention to the winners because some guy on CNBC told me just pay attention to the losers and the winners will take care of themselves. Nothing in life takes care of itself. Don't be that kind of person where I just expected some of these things to take care of themselves. It's idiotic. It's crazy. See, I couldn't be evenly balanced, Rich. Sorry. I tried.
No,
I tried to be moderate.
That's good. And look, I totally agree with you, but all I'd say is that we know that the markets can do these extraordinary things. So that's why I tend to say, if your system, if the worst case system you had was that you had something that cut losses short at all times, but allowed for unlimited growth opportunity, you've still got to trail. You must trail, because if you don't trail, you'll never be able to exploit that right tail. But
so, Rich, that reminds me of that study that someone did where they do random.
Tom Basso,
They do random entries, but with risk control. And, it didn't lose money. In fact, it made some money. And then I'm thinking, what if you applied that to the art of war? It'd be a disaster.
Yeah.
Well, if I could just weigh in on that. I don't like that cliche either, because it glosses over a very important fact that none of us have ever in our life accepted. No, we've never accepted this that cliche. And that is because we've never walked into a room and said, hey, my back test didn't lose money. I'm done. Didn't lose money. That's not our idea. Don't lose money. We need to make money. We need to have great performance. We're going to go up against the greatest minds in finance, and a random entry that doesn't lose money means nothing. It's not success. It doesn't lose money. So what? Lots of things don't lose money. Random entries, I'm not sure what that's supposed to prove, but it doesn't prove very much to me.
What I think he was doing, I think Harding also came out with it as well. They wanted to demonstrate that if you had a random entry, but, and this is the important point, Jerry, because this really supports you, they must have strict profit-taking rules. They must have trailing exits, etc. When they deploy just random entries with those strict rules, you can get decent returns out of them because it's exploiting the asymmetry and it's exploiting the winners under those scenarios. So what they're talking about is simply the random entry. It's certainly not the random exit. The exits are managed. So this comes down to that question: are entries more important than exits, or whatever? And you get these debates from both sides, etc. I tend to
don't like that one either.
Yeah.
Well, obviously, a trade has two points, right? The entry and the exits. You need both.
Yeah,
I think to make it all.
Jerry, when you say you don't like that one, is it more like you can't predict with any certainty what would be better? An entry might be better than an exit, or an exit might be better than an entry. There's no way to have like one path. Is that what you're saying?
I guess I don't like these cliches that purport to have this incredible wisdom, but when you break it down, there is no wisdom. In fact, It gets in the way of true wisdom, which is be concerned with your entries, be concerned with your exits. Is thinking exits actually a human frailty? Yes, it is. Because the reason we think exits are more important is because they have an inordinate impact on our performance. We've got this big, huge cocoa trade that made all of this money. The entry, we've done 100 times and we've taken 100 losses. And we keep getting in and we keep taking small losses. They're never going to matter as much to our small human brain, because where we get out of this cocoa is going to make our entire year. It has no impact on our whole career. But this particular year, because I'm a human, I think this is the most important thing in my entire universe ever. But it's not, but it feels like it is. And I'm going to get clients. I'm going to make money. I'm going to grow my business, possibly based upon this performance, and cocoa is dominating it. So if my exit is close to the high, it's very important. If I gave back too much profit, that was a huge mistake, which it really wasn't. The exits feel important. They feel more important strictly because there's more on the line on this particular trade. All of focusing on these two issues is a mistake. We should treat these trades the same way each time for the future. Trend following has no claim to handle any current trade optimally. It's all of the trades that will be handled optimally. And that doesn't make us feel good in the moment.
We're trading a system that's been defined by rules, and that system has entries, exits, etc. It's a bit like Moose, having a weapon with a great muzzle velocity, but finding that the cartridge doesn't work. You need all the components to work, and all of our components, our entry rules, our exit rules, they're all integrated into the system result. That's the rules. That's
systems drive behaviors.
Yeah.
The reason why we joke, like Ben and I were joking, like we're not soldiers, there is a reality that the Marine is a system. The Marine Corps and the way we're taught, that's a system. And those systems drive behaviors which differentiate from a conventional soldier, which is a product of a different system.
Yeah, exactly. All right, well, let's move on to our final segment. This is the strategist's mind.
Can I say one final thing? And this is like where Paul McCartney wishes John Lennon was here, because Ponch and I, how we approach that in kind of a McCartney-Lennon type scenario of how we collaborate. But one of the things that we came up with on our podcast years ago was exactly what Jerry's doing right now. We've said this a million times on the show. So today our guest knows nothing about John Boyd, yet knows everything about John Boyd because Jerry's conceptually hitting destruction and creation, the strategic game, organic design for community, all those things. That and it drives the point that we make all the time is that successful people that are operating in unfolding circumstances, they inherently understand these things, or they implicitly understand these things. And our thesis has always been that when you explicitly understand these things, then your gap gets even wider between excellence and the average. You can break through even further because you understand how it all works, and you're seeking to constantly understand how it all works rather than be an analyst and just be content with whatever it is that you were taught and then try to reapply that template of success everywhere. So just another example. That's
Jerry
all.
was a legend, Moose. And
one of the things I'm fascinated with, and we don't have time today, of course, but I'm fascinated by this John Maynard Keynes and Mises. That thing when you talked about a few minutes ago. I think that there's no amount of evidence that's going to change some people's minds. I think that is really fascinating and probably has some trend following. Yeah, there's no amount of evidence of trend following. No matter what you say and do, some people cannot accept it. Why is that? I mean, that is a real phenomenon. Boyd suffered the same fate. It's like, why is it that I can show conceptually that all of these big, beefy, bulky, over-bloated bureaucratic military programs are completely wrong and are sending us down the wrong path, and we know the truth? Why is it that prevails? It's the same thing. It's the exact same concept. It sucks. It's like kind of reminds me too, if you've ever read Atlas Shrugged by Ayn Rand. They're like, people are just befuddled. Like, how could people actually be this opaque? How could people actually be this obtuse?
We've got the sharp worldists in our camp as well, which is befuddles me. So same thing.
Exactly.
Yeah.
Orthodox.
Well, that's our mission. That's the fun part, is that we get to fight these guys, and we get to, we get to be hitting them with Cheng and Qi maneuvers and confounding them. That's the best part of it.
Yeah. And then if we woke up one day and said, and the whole world said, "Oh yeah, I finally get it. You guys are correct," we'd be so disappointed. There's no more fighting,
and we'd also be so far ahead of them they wouldn't even have time to catch up. That's eventually people do embrace novelty. Like Blockbuster, Kodak. I mean, at one point, bringing digital photography in from the actual company that made it at Kodak. Now they all do it now, but it wasn't easy, and they got fought and laughed at the whole way down, and. I write about that a lot. I put a link in there about, orientation as capital, but, talking about Mises and Hayek. I mean, I've spent literally years of my life working on this, but also too, like, wondering exactly as Jerry said, like, how is it that Keynes, in spite of being completely debunked, and then in the military world, it's like, how is it that someone can write a book, and wrap it in a wrapper that looks appealing to us, but in reality, it's just Orthodox Clausewitz, which has been debunked, which Boyd disarmed. If you go back and you read this book, I don't know if we're censoring this or using colorful language, but Boyd's language for Clausewitz was, I got the effer. I got him right by the balls. Like, I mean, that's what he said. Like, he absolutely destroyed Clausewitz with like 2 or 3 different translations. And having been in the archives and spent days in the archives down in Quantico and reading his margin notes, I took a picture of every single one of his margin notes on War. Absolutely, I can't imagine in any circle how someone serious about military strategy would still think that Clausewitz is the prevailing mind and the prevailing one, the one that we should all emulate. And it's no different than my experience in asset management and economics. How is it possible that people still look to Keynes as the pinnacle of truth and whatever, and it's been completely debunked because it's disconnected from reality as reality unfolds?
But sometimes we're asking the wrong question. And it reminds me a little bit of today's politics in the U.S. And if you went to one side and says, if we adopted all of your policies, it would lead to somewhat like economic ruin. And our problem is we think they care about economic ruin. They don't.
They don't.
No. And so that's our fault because we think we have it all laid out. Here's the spreadsheet. Here's what you need to be successful. And they're like, no, we reject that. We reject the fundamental beliefs that you have. And we can't really understand that. We're like, oh, we live on different planets. We can't understand why you despise progress. Yeah. Oh, well.
Yeah, you put up a lot of good stuff on X about weather and climate and stuff like that. And there literally are people, as you say, I do believe that they're on other planets. Like they don't think that we're accelerating around the sun or we're accelerating in the cosmos. Like they can't zoom out and see that. They can only see like the one picture that fits a very narrow frame of their tribe or whatever. And then what does that do? Well, that's the opposite of what you're talking about, and that's the opposite of what Boyd is talking about. If we're not challenging all assumptions, then otherwise, whatever we think is some kind of doctrine about X or whatever, that becomes dogma, and then it's hard to break dogma, and people are going to be so dogmatic to the point where it literally kills them. Where they'll never know what hit them when novelty comes. And that's where Blockbuster went down the toilet with Netflix. And that's where Kodak and Polaroid got destroyed by digital photography, because their dogma of what they had always done, what had always worked, what had paid all of my bills, my kids' boarding school tuition, whatever it was, I couldn't imagine something different than that in a novel world of unfolding reality and unfolding circumstances. And when that novelty hit me, I just took solace in what I'd already known, and even when that became obsolete,
back to their back test in the mirror, as you talk about.
Yeah.
I ran across this guy in the 80s in Texas when oil. We were short. One of our biggest trades was short crude in '86, and we shorted it at 40, and it went down to 10. And I was in Texas with friends and relatives. And one of my friends worked for an oil company, and he put together a plan for the company to survive this big downtrend in the price of oil. And the owner rejected the plan, and he said, let's just let it go to zero. So yeah, that's a mentality of some people, where we'd be saying, where's our stop loss? Where's our ability to stay in the game and come back later? And some people say, no, if let it go to the ground if it has to. And I would just say also that when you run across people like this who are living on a different planet, it is possible that the only alternative is war. That's the only alternative, because you speak such a foreign language and you can't come to any kind of compromise or common ground. Then there is no other choice. But yeah. If you're dumb and you fail in the markets,
in Australia, or are you happy you're over in the southern hemisphere with me at the moment?
Yeah.
Well, there is an alternative. You could just move to a gated community.
You could surrender. That's another alternative. You could surrender.
Or just accept that this is how the world works, that the world is always in a constant state of flux. Therefore, I have to destroy and create my perception of it, because what worked at one point is not going to necessarily work in the future. And if I don't have that openness, if I don't have that variety, that tendency to act rapidly inside of that when I identify mismatches, and if I'm not open to that, then I'm going to be obsolesced. I mean, again, I go back to John Boyd's Destruction and Creation. Is if you want to be a successful anything, certainly a trend following trader, you better not only read it, but you better understand it, because if you're successful, you're already doing it inherently. And as you go through it explicitly, and then you realize that that's the core of work that's riffed off of in all different categories, then I'm going to understand that, yeah, it is a volatile, uncertain, complex, and ambiguous world. And yes, I do have to constantly reorient and update my cognitive software. Otherwise, I'm going to be obsolesced. I'm going to be defeated. I'll perish, and I'll never know what. And oftentimes, I won't even know what hit me, because the surprise is going to be so overwhelming. I'll be rendered completely neutral.
All right, gents.
You can tell I get excited about this because this is like...
No, that's good. That's great. It's been a heated one. So let's move on to the final segment.
Heated, and we're all in alignment. That's the best part. Like,
Yes.
we're heated, and we're like... Yeah, that's the best part. We're heated together. Like, bring them on. Come on, let's go. Bring the opponents.
Rich, maybe we should consider bringing on people in the future who are not in alignment. And let's really get heated.
That'll be popular.
Let's put me and Jerry on one side, and then we'll get an Orthodox Keynesian on the other side, and like a Clausewitzian on the other side, and we'll go to town.
Or in trend following parlance, we'll have classic trend versus dynamic position sizing. Who could we find? Who could we find that would defend such nonsense? Well, there'd have to be lots of people, but would they come on this show? I doubt it.
No. We should test it out. Anyway.
Yes.
All right. Let's finish with the strategist's mind. This is where we talk about the mind itself, because everything we've discussed today comes back to it. Friction, the fog, the loop, tempo, the rare winner, knowing when to let go, surviving the blow. Underneath all of it sits one thing, a mind that holds its view of the world lightly and knows the moment that view has stopped matching reality and has the courage to tear it up and build a new one. That is not a trick or a technique, it's a way of being. It's a real skill under all of the others. So let me explain this from my point of view. So I want to tell you about a moment I gave up trying to predict the market. So the failure that finally broke the habit for me, and it turned me into someone who doesn't forecast the future. So this was the lesson, and hopefully it resonates with some of you. So the failure that finally broke my habit of prediction, this is what turned me into a trend follower. And this is back in my value investing days when I was trading small cap stocks, and I thought I'd found a clever edge. My idea was this: don't chase what we call the blue chip stocks over in Australia, the big names everyone's already watching. Instead, look at the small companies quietly connected to those blue chip stocks, the little suppliers, the penny stocks feeding the giants. Everyone had their eyes on the blue chip stocks, almost nobody was watching the minnows. And that gap, I thought, was my advantage. So one of those minnows was a small listed company that supplied equipment to one of the big miners here in Australia. It was BHP. And my logic felt airtight. If the big miner posts a great earnings report, that strength therefore has to flow downhill to its supplier. So I'd be positioned in the supplier before the rest of the market connected the dots. I thought it was a clean edge, and I thought it was hiding in plain sight. So when the miner came out with a strong bullish earnings report, I backed my theory and I invested heavily in that small supplier. But here's what I didn't see. I'd read the earnings report, but I had not read the fine print of the contract between the miner and the supplier. And at almost the exact moment I was buying in, the miner was replacing the supplier. So a new supplier was taking over the contract. So the very thing I was betting on had already been cut at the root, and I had no idea. So what followed was a tail event for me, a violent outsized move, and I was on the wrong side of it all. So this is what reminds me back in our last episode of the horseshoe nail that we talked about. For want of a nail, the kingdom was lost. Well, for me, it was for want of one clause in a contract I never read. My whole thesis was lost. So the chain was invisible to me from where I stood. I could see the earnings report. I could not see the thread running from that one contract all the way to my position. And only afterwards, in hindsight, did the whole sequence make perfect sense to me. So this was one of the moments that broke the predicting habit in me, because the lesson to me was brutal and simple. I didn't lose because I was lazy or careless. I lost because the future held a piece of information I could not have priced in, no matter how clever my theory was. There's always another contract you did not read, always another nail you didn't see. And the price already knew. The moment that contract turned, it began showing up in the price itself, in the behaviour of the stock, before any report ever told me. So the market was writing the answer in real time, and I was busy arguing it from my spreadsheet. So that's where I stopped outguessing the chain. I started following the one thing that the whole story was baked into. So that's about following price. So Moose, this is really Boyd's deepest point, isn't it? That's the strategist's real work. Isn't the plan? It's on how he sees. So can you take us there with Boyd's understanding?
Yeah, I mean, this is his, I put on the screen, this is from his briefing, The Strategic Game of question mark. And as I alluded to earlier, the two question marks are interaction and isolation, but strategy is a flow between the moral, mental, and physical, and vice versa, the physical, mental, and moral, the cognitive, constantly changing intentions. I accept that there is no such thing as perfect information. I want to shape and adapt things. When you talked about the horse and the nail and that other scenario, I mean, it's a lot like being completely blind to things like the butterfly effect, and understand complexity on how there's connectivity that we can't see. That, you know, that I it's not enough to see what I can see, but I also have to see the unseen as well, or I have to consider the unseen as well, and I have to be prepared to anticipate that, because at a minimum something is going to change, and I'm not going to be able to know with exact certainty what will happen, just given the nature of the universe. I don't know if everybody can see those, but if you look at his fundamental definition at the top, it's a mental tapestry for changing intentions, for harmonizing and focusing efforts as a basis for realizing some aim or purpose in an unfolding and often unforeseen world of many bewildering events and contending interests. And Rich, that's exactly what you just described. Unforeseen, bewildering events, or waiting for perfect information, or whatever. There's no way that I could always account and know for those things. And if my strategy is a fixed plan, or if it's a static, ingranite approach, I'm likely to get rolled, because reality doesn't work that way. The universe doesn't work that way. I have to be able to be open to possibilities that I can't see, because I know that I can't see everything with complete certainty and clarity. Marshall McLuhan called this the difference between figure and ground. So much of us are looking at figures, things that we can see, and what it is that we don't realize beneath us is the ground that's shifting, and we have no understanding of that. So it's not the figures that roll us, it's the ground that changed, and we didn't think about it, we didn't consider it, we didn't allow for that. We weren't open to those possibilities at all.
Perfect. Jerry, 4 decades in, what's actually kept you in the game? Because I don't think it's being right. So what's kept you in the game?
Well, I love the knowledge behind what we do, and I want to see it play out, and I want to see how long it can work. I believe in trend following, and I believe I think what's important, diversification and risk control and classic trend, more than I ever have. And I think there's nothing more important to having fun doing this, and preserving your, seeing it work every day, and seeing how it's going to work against other people and other ideas. It's just, the most fun game going. I have a lot. My whole career is just believing in this, and sort of every day waking up and watching it work again, and seeing if anything can work better. I'd be willing to change at any point in time, but I don't think I haven't found anything better than what we do.
Yeah. Adam, the hardest part of all of this is psychological. So, holding your own view lightly enough to drop it when it stops working. So why is that so hard for us as humans, and what helps?
So what kind of mistakes can you make in trading? And broadly, we can break them down into type 1 errors and type 2 errors. So it's your classic false positive or false negative. So what is a false positive or type 1 error? That's entering an invalid low quality trade, perhaps reflected colloquially as over trading. Your type 2 error, that's your false negative, that's hesitating and missing a valid high quality trade. And they are both going to impact your P&L, maybe somewhat differently, but they're both really, really important errors to avoid and get out of your trading reality. And so the core emotion around these false positive type 1 errors, it's greed and impatience, right? So if you're the kind of person who is greedy or impatient, you've got to focus on these type 1 errors. Type 2 errors, your false negatives, not taking the high quality signal. Fear and paralysis, right? You're the kind of person who, even when they know exactly what they need to do, they can't pull the trigger, right? And these two types of errors are going to have different impacts on your portfolio, but the overtrading is going to basically bleed your capital through commissions, spreads, and lots of small losses. Hopefully you cut them quickly and don't let them turn into big losses. And then your type 2 errors, well, you're just going to be missing out on those big trades that are going to be potentially huge contributors to P&L and can't be known beforehand because, as we know, we're dealing with a state of change in equilibrium, right? So basically our understanding of the world is probably going to change as the result of, this trade or this movement in the markets. And so in addition to things like checklists, trading logs, automated execution, position sizing that's automated, and binary trading signals, I think people can also look inside themselves, their personalities, and I think these types of errors manifest themselves in different personality types differently. And I think it's a fascinating topic to go back and not only look at your trade log or your trade history, but if you are making errors, if there is a pattern in there, perhaps there is a path to improvement through identifying that pattern and then using elements of psychology to hopefully reduce those type 1 and type 2 errors.
Perfect. All right, so I'm going to send a general question to the room and get the view from both camps. So if the whole game on both sides of the door, from the trend followers and the Marines, comes down to tearing up your model of the world before it traps you, then what is really left that separates a great Marine from a great trend follower? So once you set aside the one fact we keep returning to, that one of you is handed a price and the other is not, I want both your views. So from the war camp, Moose.
I think it's the willingness and the humility to learn, to always be in a state of continuous learning, and continuous learning leads to continuous adapting, and that's how we not only survive on our own terms, but that's how we thrive.
Yep.
It's kind of oxymoronic in some circles, but the Marine Corps is actually the most intellectual branch of all of the services in the States, because we're actually given a very small book of things that we can't do, and then what we can do is whatever we want to do, or within the constraints, to get the mission done. Well, that comes with a lot of challenging of assumptions, and that comes with a lot of learning, and that comes with a lot of accepting that you don't know everything, and that you have to be in a continuous state of learning. I mean, this is no accident. I mean, I'm surrounded by learning in books everywhere I go, but that was amplified by my experience as as a Marine. And Boyd, quite frankly, was a big part of ensuring that was kind of the operating mantra of a Marine, that you constantly learn, you constantly challenge your assumptions. There is no one right way. Doesn't mean that we don't learn procedures and tactics and techniques and disciplines and all that. It's just that when we apply those, we're not limited inside a box the way that others might be. So you constantly have to expand your knowledge and be extremely interdisciplinary. If you look at the inputs into his own work, it not only pulled from Boyd, it not only pulled from the military, it pulled from science, math, engineering, philosophy, economics, theology, literature, everything that you could think of, where he was isolating and identifying concepts and patterns that apply to all humans making decisions in volatile, uncertain, complex, and ambiguous environments. And in reality, that's everywhere. And it's more profound and felt, I think, by traders and by Marines engaged in training, combat, whatever, because so much is at stake. And when so much is at stake, if I'm not challenging my assumptions, if I'm not learning, then there's no way that I can adapt. And if I'm not adapting when there's so much at stake, including life or my fortune, well, I'm going to be in a lot of trouble. And either the market is going to reorient me or my competition will reorient me if I don't reorient myself.
All right, gents. So, trend followers, do we have anything to say finally for this last segment? Adam, anything more to add?
Well, look, I love the idea that both trend followers and Marines are operating comfortably in chaos. So I think that's great. There's a great parallel there. I find sometimes these markets are just so chaotic and you've got no idea what's going on. And I can only imagine what it would be like to be in active conflict or warfare. So I think there is a parallel there, but the stakes are just so different. The Marine is playing a very, very high stakes game. Ultimately risking their life for a military outcome. And trend followers, whilst we'd like to think the money game is a high stakes venture, I think we're more focused on sort of working that win rate, the 40% winners, the 60% losers, and just handling these micro losses continuously whilst still trying to stay in the game for the big moves.
Perfect. Jerry, anything you'd like to close on here?
Well, I'll just talk about this bad analogy that I frequently use, mainly coming from the turtle experience, and that is, I think it's being a great trader and trend follower is really difficult if all you are handed is the book. Here's how we trade, or you read articles and interviews, and handing a Marine a book and say, here's the book on being a Marine. Now you go out and be a soldier is not the way it's done. There's a boot camp, there's Quantico, whatever. And in the same way, if you need mentors, you need to suffer and lose and see what the markets are really like and get out of your ivory tower and all the classes that you took for your PhD on math and see what the markets are really like and what trend is really like. And but nothing is going to replace a mentor and submitting yourself to other traders who have gone through the battles and understanding what it was really like. I think back tests are great and math is great, but it's just a part of rounding out the trader that everybody can be.
Perfect, Jerry. All right, well, I think that wraps this episode and this series up. But look, before we go, I'd like to thank the men who made this special. To Moose, who came on to a trend-following show and showed us how much of our own world we could see in his. And to Ben, of course, who could not be with us today, but was such a part of this conversation getting started. Thanks both of you for your generosity and being on this show. And a word for Mike Melissinos, who's absent today, but who brought the the live portfolio and the energy, certainly the energy to get restricted by YouTube to part one for his illuminating language. Now, this feels like the right moment to say something else. So this may be our last episode for a while. We're taking a well-earned break because we're considering changing the format and bringing you something rather different going forward. But nothing is decided yet, and we'll keep you posted on when or if the show returns in a new shape. Which makes this moment, I want to take this moment to thank people properly. So, Jerry, 15 episodes of the calmest, most generous wisdom anyone could ask for. You've given this show its backbone, and I'm truly grateful for every one of them. And Adam, my co-host, for keeping us all honest about what is really going on between the ears and for making this a partnership rather than a solo act. And to all of you listening, whether you came from the markets or the military, thank you for walking all 8 of these ideas with us over these 2 episodes. And for the 15 episodes for some of our listeners who've turned up. We've loved making this for you all. And if we come back in a new form, you'll be the first to know. Well, that's a wrap for episode 15 of Turtle Talk. So, as always, stay systematic, stay patient, and may the trend be with you.
Thanks for tuning into Turtle Talk. If you enjoyed the episode, don't forget to rate and review the podcast. It really helps us reach more listeners. Share it with your friends and invite them to join the conversation. Got a question for us? Send it to info@aussieturtles.com, and we'll do our best to feature it on a future episode. Please note, Turtle Talk is for informational and educational purposes only. The views expressed by the hosts and guests are their own, and do not necessarily reflect the opinions of the podcast producers or affiliates. This podcast does not provide financial, investment, or professional advice. Always consult with a qualified professional before making investment decisions. That's it for today, folks. See you next time, and as always, may the trend be with you.